Hi guys, welcome to this Moneycontrol live stream. You're watching Opening Bell with me, Nandita Khemka. Well, it promises to be another rainy day here in Mumbai. Of course, Mumbai is on red alert, so is Kerala, as rains continue to wreak havoc on regular life. But if you look at the Lal Street action, it has been raining gains there as well over the last two sessions. In fact, yesterday the Nifty ended above that 25,000 mark. So yes, good traction yesterday, although the trade was pretty much range bound. But now the next level to watch out for on the Nifty would be 25,200. According to experts, that's the key resistance zone on the upside to watch out for. But in terms of the GIFT Nifty this morning, it's fairly flattish. It is hinting at a muted start with a negative bias. Even in the pre-open, we can see a 40-point downtick on the index. So yes, we are bracing for a muted start, but let's see if buying comes in, and we could perhaps see the Nifty pick up steam once again. Broader markets were also fairly upbeat yesterday. The mid-cap index was outperforming. The breadth was fairly strong. Autos and IT were among the top gainers, and all those monsoon-focused stocks and sectors like FMCG, autos, were seeing buying traction yesterday. Global cues this morning looking fairly mixed. US markets were shut on account of Memorial Day yesterday. So yes, that action was missing, but lots to digest. Lots of stocks in focus. IndiGo, may see a block deal. Promoter family Rakesh Gangwal is expected to sell stake of 3 to 3.5% or thereabouts. Lots of action lined up over the next 40 minutes. Keep your stock related queries coming in on a live feed. We will try and get them addressed as well. But before we move any further, let's quickly take a look at the top headlines at this hour. Well, Asian markets are mixed as investors digest, the trade and tariff related developments. GIFT Nifty is indicating a flat start for the Indian market. Oil prices hold steady as market awaits clarity on OPEC Plus and its next move with the meet planned on May 31st. Meanwhile, gold prices decline after Trump extends tariff deadline on EU goods. Market regulator SEBI seeks proposal from BSE and NSE on the finalization of expiry days by June 15th. SEBI has retained its stance to keep one expiry a week per exchange, falling either on Tuesday or Thursday. IndiGo promoter Rakesh Gangwal likely to sell over 3% stake in the company through block deals today. Sources suggest that the floor price is at a discount of over 4% and Gangwal is hoping to raise more than 6,800 crore rupees. Kochi and 10 other districts in Kerala remain under a red alert as heavy rains continue to wreak havoc. The IMD has warned of heavy rainfall with thunderstorms and gusty winds in Mumbai and neighbouring districts of Thane, Raigad and Ratnagiri. Well, those were the top stories. Just about 6 minutes to go for the markets to open. Quickly take a look at the action from yesterday. As I mentioned, we ended above the 25,000 mark on the Nifty. Autos, IT among the top gainers. Metals were also seeing good traction yesterday. Mid caps outperformed. NSE advanced decline ratio was at 2:1. Defense stocks have been seeing an uptick for the last 4 sessions. In fact, the Nifty India defense index was also up and about yesterday. In terms of fund flows, we saw second straight day of buying coming in from the FI community, 140 crore rupees or so. That was the buy figure in the cash markets in equities. Meager, but it was the second straight day of buying. DIIs, bought stocks worth 1,800 or 1,750 crore rupees in the cash market. In terms of the put call ratio, it fell to 1.06 from 1.09 in the previous session. There will be some stocks in the F&O ban. No new additions, but Chambal Fertilizer, Hindustan Copper, Manappuram Finance, RBL Bank and Titagarh Rail continue to be in the ban list. Out of ban, we have one stock coming out of F&O ban, that's Dixon Technologies. A few additions in the F&O universe: 361 WAM, Amber Enterprises, K Fintech and PG Electroplast. These are some of the new additions that will take place in the FNO universe, and these new additions will be effective 27th of June. So, heightened volumes in these counters going forward once they enter the FNO segment from the 27th of June. But on that note, let me bring on board our technical guest for today. Joining me is Ajit Mishra, Senior VP Technical Research at Religare Broking. Ajit, lovely chatting with you. We have been witnessing great traction in the market, 25,000 back on the charts, but how does it look like as we step into monthly FNO expiry that's taking place on Thursday? Do you expect 25,200 to be hit before that, or do you think we could see some bit of consolidation kicking in?
Yeah, good morning, Nandita. So, Nandita, last week was the week of consolidation, but on Friday, in fact, on Thursday itself, we tested the critical support of 20 EMA, the short-term moving average, the first line of defense, and then we rebounded. And since then, we are seeing the recovery continuing, means we have reached to that mark, the previous swing high, close to around 25,100 again. As you rightly mentioned, that 25,200 rather is the critical hurdle to watch out for in the coming days. Until we break that mark, the sideways tone might continue with 24,800 being the immediate support. So as of now, since we are seeing buying interest emerging on every dip, that's the strategy that one should continue with. Means look for buying around 24,850, 900 zone when it comes to the index, and close to around 25,100, 200 area, you should look to book profits. Since it's a monthly expiry, expected volatility is likely to remain high, not only in the index, but on the stock specific front also. So the focus should be more on identifying the right set of stocks across sectors, banking, financials, energy, metal. They are the better bets, in comparison to the other sectors as of now.
Okay, but do you expect the Nifty Bank Index to retest life highs anytime soon? Do you see, the up move yesterday and last few days as a precursor to the index once again hitting those record levels?
Certainly. In fact, Nanda, I believe that in case if Nifty have to surpass this 25,200 levels, banking should play a critical role because almost after a 7,000 point kind of a rally, making a new record high, we are seeing almost a 1 month long consolidation, in the banking index while holding above its short-term averages. So it seems like that banking is taking a breather after the strong move, and in the next leg, once let's say we cross 56,000 mark, then probably we can see a fresh momentum which can help the index to inch toward 57,500 levels also. So yes, banking is something that you should keep on your radar, and within the banking also we are seeing across sectors, be the private PSUs offering buying opportunities. So even we might take a session or two to surpass the hurdle of 5600 mark, 56,000 mark. One should continue with buy on dips in the banking space as well.
Okay, buy on dips in the banking space. That should be the strategy. Just about 1.5 minutes to go for the markets to open. I want to talk about the stock of the day. IndiGo. The block deal size has been increased according to CNBC TV 18. Rakesh Gangwal will now sell shares up to 11,300 crore rupees. Earlier, he was eyeing, raising somewhere around 6,800 crore rupees or thereabouts. So now it has been upsize 6,800 crore rupees, and from there 11,300 crore rupees. So block deal size upgraded. In fact, sources are suggesting that Gangwal will sell up to 3.4% equity, and the floor price was at 5,175 rupees per share. That's at a discount of 4.5% to the CMP. We also have a couple of queries on our feed on what one should be doing with IndiGo now. The stock has been flat over the last 1 month and down 2% or so in the last 5 sessions. Hasn't really taken off. How do you see the shares of IndiGo shaping up going forward?
Right, so Nanda, if you see, it's been almost a month now that the stock has been hovering in a very tight range around its record highs, but the tone looks positive. And after this block deal, I believe that there's a gap on the daily chart, around 5100 levels, which might get filled. So as if you're looking for a buying opportunity around that area, closer to around 5100 mark, definitely it's a buying opportunity considering the overall trend is positive. So if this gap, get filled, so then we'll have a next leg of the up move probably. With the stop at 4,900, one can continue to look for buying opportunity around that mentioned area.
Okay, that's the view on IndiGo, but let's take stock of how the markets have opened up. As was being envisaged or as was being hinted at by the GIFT Nifty, we are looking at a negative open. In fact, we have seen a 90-point cut on the Nifty at the start. We are around the 24,900 mark. Sensex down 340 to 50 points or so. The mid cap index, now the fall here is a lot more measured. It's flat. In fact, it's trying to break into the positive territory as we speak. Bank Nifty as well on the back foot. 0.3% kind of a cut here. The advance decline ratio, although, is looking positive at the current juncture. It is tilted in favor of gainers. 2:1, that's the advanced decline ratio. That's how it's looking like. But let's take a look at the sectors. Yesterday, it was the auto pack, the metal pack, the IT pack. These were some of the sectors that led from the front. But today, just taking a look at which sector is really taking the lead. Flattish, most of the sectors are, looking flat at the current juncture, but what's holding out is FMCG, Pharma, metals, PSU banks. These are some of the pockets that are holding out, but autos are trading in the red as we speak. Even IT is seeing some bit of profit taking down 0.4% or thereabouts. In terms of IndiGo, last time I checked, I think just about a second ago, in fact, it was down 2.5% or so. So shares are under pressure. The block deal is likely to take place. Aside of that, if you look at some of the other movers, the frontline movers, NTPC is the top laggard as we speak. Eternal extending its losses. There's some bit of outflows that will happen on the back of weight reduction on FTSE and MSCI. Today, I think the weight reduction took place on FTSE. So the stock is down 1.5%. Bajaj Finserv, M&M, that was among the top gainers yesterday, under pressure. HCL Tech, Grasim, Infosys, Tata Consumer, Tech Mahindra, TCS, these are some of the other laggards. Gainers list is pretty slim this morning. We are seeing BEL, Bharat Electronics, emerge as the top Nifty gainer, 1% gain here. IndusInd Bank is witnessing some bit of buying, 0.6% kind of gain here. Hindalco, Dr. Reddy's, Geo Financial and Bajaj Auto, these are just about a handful of gainers this morning. By the way, as we speak, the Nifty has broken below the 24,900 mark. It's down over 110 points or so. Before we take stock of other stocks, Ajit, on a day when the markets have taken a breather, what stocks are you recommending for viewers for either the day or the rest of the week?
Right. So, Nandita, we discussing about the banking space. So within the banking, if you see SBI, it was sitting on the sidelines for almost a month now, and it's a very tight range consolidation that we are seeing in the stock. The other PSUs, they have done their part, means we have seen decent traction, Canara Bank, Maharashtra Bank and all the others. So we believe that, the risk reward is favorable when it comes to the SBI, because in case, let's say if the consolidation extends for a day or two, still we have a very strong base at 780 mark. So until we break that mark, one should continue to look for buying opportunity and accumulation in SBI. In the next leg, close around 820, 825 is something that the stock might test. Another stock that we like is Hudco. So Hudco, in certain PSUs, apart from defense, also we are seeing traction. So here also, after almost a month-long consolidation above the short-term averages, we have seen a base formation. And here we are eyeing the next leg could help the stock to inch towards 260, 265 area. So with stop at 225, Hudco can also be considered for fresh longs.
Okay, Hudco, SBI, these are some of the stocks mentioned by Ajit. But Ajit, there's the other stock that would be in focus because of a block deal would be PG Electroplast. Now, sources suggest that promoters are looking to sell up to 5.6% stake via a block deal. They are raising somewhere around 1170 crore rupees via stake sale. The floor price was at, has been set at 740 rupees per share. And of course, the block deal will trigger lock-in of remaining stake for 180 days or thereabouts. The stock is down 1% or so. How are you viewing the charts of PG Electroplast? The stock is down 12% in the last 1 month, and even a 3-month return, is negative, down 12% or so. And on a YTD basis, the stock is down 25%. Do you expect the stock to hit the bottom anytime soon, or do you expect more downside from here?
So Nandita, the stock topped out at the beginning of the year itself, means it made a high after a phenomenal surge from roughly around 100 to 1000 plus area, and it's now trading closer to its major averages. 730 is something that you should maintain a close eye on. Until we break this mark, there will be a possibility that this consolidation might continue with 810, 815 as the upper band. Uh, in case, let's say, if we fail to hold this long-term averages, then probably we can see the next leg of the profit taking, which can push the stock towards 650 area. So as of now, one should avoid any fresh position. In case if you have any existing trades, 730 should be a 6 stop loss. In case of rebound, once we cross, let's say 825, definitely one can look for fresh buying interest also.
Okay, that's the view on a PG Electroplast. But I want to talk about some of these stocks that turned out to be volume shockers, so to say, yesterday. Balkrishna Industries, a case in point. Yesterday it was down 6.5%. Obviously, it is making some new forays which didn't really go down well with the street. But given the kind of move it saw yesterday, what would your call be on a Balkrishna Industries?
So Lanta is almost no return period. If you see that in past, yes, there was a phase where the stock inched from 22 and 3200, but from 2021 to till date, in case somebody is holding the position, is negligible returns, something that they are driving as of now. So in my opinion, one should stay on the sidelines and let the stock stabilize above 2600, 2650 area. Then only you should look for fresh long positions. Means after this gap down also, we are seeing possibility of further consolidation with major support at 2300 mark. So roughly around 300 point kind of a range is something the stock might hover in. So as of now, it's an avoid. In case if you have any existing position, 2300 should be a stop loss, and close to around 2650, you should look to liquidate your position.
Okay, that's the view on Balkrishna Industries. But let's take a look at some of the queries then that are trickling in this morning and get some of them addressed. IndiGo we've already addressed. There's a query coming in from Pankaj Kajalia on an Eicher Motors. Other two-wheeler stocks like Bajaj Auto, Hero Moto, they were upbeat yesterday, of course, the early monsoon arrival being a trigger. But within the premium space, Eicher Motors, I just want to see the chart of an Eicher Motors as to what it's doing right now. It's trading with a, cut of 0.3% or so. The stock has been extremely flat over the last 5 sessions. At 5,400, would you take a bet here? It's still got a, lot of distance to cover, so to say, if you look at the 52-week high of 5,900 or so.
Yeah, that's true. And in fact, if you see that the pace of advance has, reduced substantially in the recent times, means it made a new record high around 900 mark. And since then, we are seeing a gradual drift. The good part is that it's still holding its major averages. The volumes are very thin. So this indicates weaker hands exiting the stock in absence of any major momentum. So in case if your view is, let's say, 1 to 2 months, definitely you can consider to hold, or you can buy fresh also. 5,200 we believe is a very strong base, which is 200 points away from the current area. And for fresh momentum, those who are looking for a very short-term trend, then you should wait for a close above 5,550. Then we might see a fresh momentum, which could help the stock to inch towards previous record highs.
Okay, that's the view on Eicher. Hope that answers your query. A couple of queries on the real estate space. Hemant Singh wants to know your thoughts on how DLF is stacked up, and Komal Makecha wants to know which is the best stock in the real estate sector for the long term. DLF, in the last 1 month has rallied 17% or so. Prudent. I mean, would you really look at a DLF within the real estate space, or would you look at other names like Prestige Estates? How would you play this? And particularly for DLF, has seen a breakout, so to say, in the last 1 month. Is it expected to continue here on?
So yes, Nandita, it's been a period of decisive correction, and then this recent rebound with very strong volumes post numbers. So this is definitely encouraging, but at the same time, we are seeing that the previous distribution range is something that we are approaching towards. Means 800, 810 is a very strong hurdle for this stock. So here the risk to reward is 1:1. Means we have a support at 740. Those who are holding long position, I would recommend at least to book partial profit in case if you bought it at lower levels, and wait for the stock to stabilize above 800 for fresh buying. Within this space, I believe that Lodha is holding very strongly amid all this volatility. It continued to hold above its major averages on the multiple time frames, and in fact, it's gradually inching higher towards record high area. So that clearly shows outperformance, and probably let's say once we cross 1575 area, then 1800 plus is something that the stock might attempt. So let's say if your view is long term, Lodha is a better bet.
If you're looking for a long-term bet within the real estate space, it's Macrotech or Lodha. Before I take up other queries, I want to get in your thoughts on a Nazara Tech. The stock has seen very good up move over the last 1 month or so. Today, of course, it has taken a bit of a breather. Numbers came out. I think some brokerages have pointed out that the numbers were below expectations. Profit came in at 4 crores vis-a-vis 0.2 crores. Revenues were up 95% on a YY basis. Margins also at 6.5% vis-a-vis 1.3% on a year-on-year basis. And just reading the report from CLSA, they have an underperform call with a target price of 705. The stock is at somewhere around 1260 or so. The target price is pretty much lower, and they've cut their FY26 to FY27 revenue and PAT estimates by 2 to 9%. Today a day of breather, but last 1 month has been phenomenal. 26% gains. Would you utilize dips to get into the counter, or would you advise booking partial profits in this counter?
So Nandita, the way the stock has advanced from roughly around 900 to 1300 levels, it was almost a vertical rise with hardly any pause in between, and now we are seeing a bit of a consolidation. So the prudent approach is to at least book partial profit and let the stock revert to its mean, the short-term average, which plays around 1190 area for any fresh buying. So as of now, yes, booking profit seems a more prudent approach, and for fresh buying around 1190 or a breakout above 1320, not before that.
Okay, that's the view on Nazara. But one stock that I want to take stock of is BEML. The stock is up, I think 16-17 odd percent if you see the last 2-day moves right now. Up 3%. Yesterday it was up some 12-13%. We have a query coming in from Pravina. Wants to know it's a hold or sell. So after this move, should one hang on, or should one look at booking profits?
So yes, you should definitely hang on, because after almost 6 months of consolidation or correction, the stock has reclaimed its previous swing high. So probably it should extend this recovery and gradually inch towards its record highs, which is around 5,000 mark. So as of now 4,200, the previous swing high should be your immediate support and your stop loss. And the first hurdle could be close to around 4,650, 4,700 mark, and then 5,000 levels.
That's the view. Hang on, Pravina. But just want to quickly look at the market once. The sell-off has kind of intensified a bit. We've fallen below that 24,800 mark. So, some bit of consolidation, profit taking kicking in after a good up move over the last 2 sessions. The mid-cap index, however, is, kind of managing to hold out a bit. It's kind of trading flat with a negative bias. But let's shift focus to the next query then. This one's coming in from Siddharth on Afcon's Infra. The stock, in the last 5 sessions hasn't seen a very good run. It's at 438 or so. If somebody has to look at this particular stock within the infra basket, would you advise, or would you look at better stocks in the pocket?
Afcon, like after the initial listing, we have very limited data to, by the way, comment on, because the trend it's showing is mixed as of now. Means 495, 400 is something that broadly has been hovering in this broader range, and currently we are in the middle of the band while holding above its major averages. So it's not a good sign. Means in case if it witnesses any recovery also, there will be multiple hurdles to cross. So close to around 445 first, then 458, and then 465. So on every 5 to 10 points upside, we have some resistance or the other. So as of now, definitely you should avoid. Within the infra space, I would rather prefer NCC. NCC, if you see that post numbers, we are seeing very gradual and disciplined, recovery. And once, let's say, we cross 240 mark, then there could be a fresh momentum also in the stock. So as of now, NCC could be the bet, but wait on the sidelines until we break 240 mark decisively.
Okay, that's the view then. NCC looking better on the charts, and any recovery that we see in AFCONs could be short-lived. I have spotted a query on Bajaj Healthcare on our feed. This one's coming in from Nitin Shaji. The stock is reacting to its numbers. It's down 7% or so. Taking stock of the numbers, the company did swing to profit in the fourth quarter. It reported a profit of 11.2 crores vis-a-vis a loss of 30 crores in the same period last year, but margins have come in at 7.6% versus almost 12%. So perhaps that's turning out to be a dampener, and the stock is down 7%. What would you do with the Bajaj Healthcare now, Ajit? Down 7%?
Yes, so Nanta, if you see that it was a broader consolidation which ended, in the month of December after the breakout of a 475 mark, and the stock inched towards 725 plus area. And after recent consolidations, gradually witnessing some profit taking. Good part is that it's still holding up with major averages around 520. We have the long term averages placed, so the downside seems capped. This is the good point, but at the same time, since the volumes are low, comparatively low, so it might continue to consolidate in this band. So close to around 520 to 640 is something that stock might continue to hover in. So if you have any existing position, you may stay put and use any recovery towards 640 to reduce your position.
Okay, that's the view on Bajaj Healthcare. Hope that answers your query. I have a query coming in from Varsha Gajjar. She wants to know your thoughts on BSC post the bonus issue and the adjustments, because she was of course making profits on her holdings. She's a bit confused as to how the adjustments have taken place, because now for her it is showing in the red. So I mean, how should one navigate if they've been holding the stock pre-bonus issue? How should one really look at it now?
I guess there could be some problem with the reading, because the stock is still trading closer to its record high. So it's 2:1 the bonus ratio, and still the stock is trading closer to its record high zone. So 2300 is something that should maintain as a stop loss in case if the view is very short term. And in the next leg, let's say if it manages to cross 2520, then probably we can see fresh leg of momentum also. So as of now, the trend is still positive. You can stay put with 2300 as a stop loss.
Okay, that's the view, Varsha. I hope that clarifies your confusion. And hang on, that's the call from Ajit. One query coming in from Anunay. He wants to know your thoughts on Lloyd Metals. He's bought shares at 1327. The stock is trading at 1358. Mild profits here. What's the strategy he should adopt? The stock is done well. If you look at the last month or so, 10% gain, and last 6 months it has rallied in excess of 40%.
That's true, and in fact, it's gradually inching towards its record highs. That's a good sign. Means we are seeing decent volumes on up days. So we have base formation also after this recent up move. So close to around 1290.95 is something that we have the immediate base. So with that as a stop loss, you can continue to hold 1450, the previous record high. That should be his target zone. So the risk reward is favorable. You can continue to stay put.
Okay, that's the view on Lloyd Metals. I hope that answers your query. We have time for just about one or two more queries then. Let's take up one on e-clerks then. This gentleman has bought e-clerks at 2,431. Wants to know whether he should trail or book profits. Your thoughts here, Ajit, e-clerks?
He should certainly book profits, because from 2300, 3400 in no time. So there'll be probably consolidation or maybe some profit taking also in case if it breaks 3300 mark. So at least book partial profit around current area, and for the remaining position, 3290 should be a strict stop loss, because in case if it breaks, then probably we can see further decline towards 3150 mark. in the next leg, let's say it manages to hold 3300 mark, then probably it can gradually inch toward 3600, 3650 also. So around that area, he should book complete.
Okay, that's the view on e-clerks. Couple of more queries then. I spotted one on NMDC that has just come in from Ratna Kumar Solomon. For the long term, what should he do with NMDC? He is making some bit of a profit at the current juncture, but it's very mild. Should he hold on? Because stock has seen good traction. The 52-week high is 92 or so, and the stock is 20 rupees away from that level. Do you see that level being attempted, or the stock attempting to reclaim those levels? Is this or the stock, is it just in the middle of an up move, or do you think the up move it has seen over the last month or so has kind of run its course?
So in fact, Nandita, I believe that the stock has witnessed a fresh reversal, means almost after witnessing a year-long corrective phase, we are seeing that stock has surpassed its declining trend line, reclaims major averages. And if I'm not wrong, today the results are also scheduled. So probably we might get hint, from that front also. But broadly, I believe that the trend is positive, has turned positive, and 66.65 is a very strong base now. So with that as a stop loss, you can definitely wait for the long term also. In the first leg, close to around 78, and then around the 86, 88, means the record high zone is something that the stock might attempt.
Okay, that's the view on NMDC. Results will be coming out, so perhaps that could be another trigger for the stock as well. But with that, we've come to the end of the query segment, and Ajit would like to thank you for taking out time and joining in this morning and sharing your thoughts. Look forward to our next interaction as well. Hope you have a great day.
Thank you, Nandita. Same to you.
Thank you. Well, on that note, taking a look at the market, we're down 180 points above that 24,800 mark as of now. We did test that level a little earlier, and the mid cap index as well in the red. Advanced decline ratio has now turned in favor of losers. But on that note, let's bring on board our next guest. Joining me is Anshul Saigal, market expert. Anshul, lovely having you on the show today. Just want to get in your thoughts on the movement that we have seen in the market. From April lows, we are up 15% or so on the headline indices. Would you be a little wary of valuations? Do you think we are back in the expensive zone? How are you looking at the valuation picture now when it comes to the headline indices?
Morning, Nandita. Always a pleasure to speak with you. So on the valuations front, there are two aspects to valuations. One is the aspect of putting earnings and price on an Excel sheet and figuring out what the PE ratio is. And that tells you only one part of the story. The real value in assessing valuations is in identifying what is the ownership. So that is a much more nebulous sort of an assessment of the markets. When we were in, say, the last quarter of last year, and we saw that the markets were on a tear one way and up, everybody was jumping into the markets and buying, while valuations were high, but so were the ownership. Ownership was quite high at that time. Markets were heavy. But come the first quarter of the current calendar year, and we saw a marked correction in the broader markets. Not so much in the frontline index, but in the broader markets, we saw a significant correction. And you could have picked the stock and it would be down between 30 and 50% from recent highs. What that told you is that ownership in the market had lightened down, and that there was, that heaviness that we were seeing in the previous year, that had eased off. And so it was a nice setup, particularly if earnings were to do well, for the markets to start moving up. We've seen some of that rally play out just now, but I must tell you that stocks are still lower than previous highs, even as we speak. and that growth patterns, when we speak with companies, are not diminished at all. So growth for the long term, particularly in the second half of this year and thereafter, looks quite robust. And as a result, we don't think that valuations as also ownership are at levels that one should be worried or overly sort of concerned at this moment.
Let's talk about the triggers for the markets going forward, right? With the monsoons arriving ahead of schedule, I just want to ask you, how do you see this influencing market sentiment? Because there was an anticipation of normal monsoon any which ways. Do you think that is already priced in? And how are you looking at agri-linked sectors and rural demand-driven stocks in the near term as a result of the early arrival of monsoons?
So, Nandita, yes, the monsoons have come in a little earlier than anticipated. Although the expectation was that this will be a warmer than usual sort of a season, and as a result, power demand was expected to be quite robust, which expectation in the last few days has taken a bit of a hit, particularly for the month of May. One hears that power demand is lower than what was expected earlier. On the other hand, the sector that you mentioned, which is agri related sectors, whether it is seeds or agrochemicals or other such implements, etc., all those sectors, um, there may be a slight impact in that space, but what one has seen over the years, if you have been tracking the markets over a long period and through cycles, you will realize that these are one or two sectors may take an impact because of monsoons in the short term, but over the long term it all plays out fine. And as it is, the agrochem sector is coming off a low base of the previous year, and we don't think that this early onset of monsoon will have a material impact on the sector going forward. If at all, it'll at the margin be offering tailwinds to the agri sector as also to related sectors in the coming few months and quarters.
Got your point, Anshul. But I want to understand going forward what could be a key trigger for the market. There was a lot of optimism, regarding the U.S.-India tariff deal as well. The talks may be maybe in the final lap. An interim deal is likely by the 8th of July. So, would you say a lot of optimism over tariff deal is already factored in? What could be the next major trigger for the market here on?
Nandita, actually, if you see where the tariffs were applied on the country, at what levels, they were at around 25, 26%. And gradually it is, that was the sort of the maximalist sort of situation, or the worst case for the country. Now, gradually that expectation has been tempered down, which means that tariffs are likely to be in favor of the Indian economy, and in fact, we have been speaking in those terms ever since the tariff situation actually came up. We believe that India will be a net beneficiary of the tariff situation. The tariffs are applied globally with the assessment that because of tariffs, business will move back into the country, manufacturing, that is the US, manufacturing will move back to the US, and jobs will move back to the US. And so logically, tariffs were more potent on countries where the trade deficit versus US is highly unfavorable or favorable towards those countries. Now, India has such a small trade with US that it looks unlikely that tariffs will have an adverse impact on India. At the margin, India will be a beneficiary. So this can clearly be a positive trigger for the markets. The Russia-Ukraine war, or also the war in the Middle East, those seem to be in their final stages. If those are out, clearly that will be a positive. If China, US, they reach an agreement, and it is better than what people anticipate, that will be a positive. A general um, trend towards capex creation globally. Also, the defense spends going up, which will spur activity on capital creation. That will be a positive for the global markets. So, in our judgment, we are in a situation where there are many positives in the offing. Most negatives are in the price. That is a good setup for the markets.
Okay, a good setup for the market. But have you made any adjustments to your year-end, Nifty targets? Would you expect higher returns now, given the fact that you mentioned that we have all the negatives already in the price?
Nandita, I, our investment style is that we don't really focus too much on the Nifty levels. We believe that bear markets are narrow bull markets. What I mean by that is that if a thousand companies we are tracking and 950 are down in a bear market, there are still those 50 which are going to be up. It is left to us as good analysts to identify those 50 so that we can outperform the markets materially. And so also a bull market is a
Sure.
narrow bear market. A thousand companies, 950 go up, 50 also come down. So it is left to us as good analysts to avoid those 50 companies. We believe that given where we are in the market situation today, the opportunity size has expanded materially. Why I say that is because in the last quarter, many stocks which were highly coveted by the markets, those have corrected between 30 and 50%. From the lows, they have gone up a little bit, but they are still much lower than peak levels, and valuations are much more reasonable than in the last quarter of last year. That offers us opportunity because when we speak with many of these quality companies, they tell us that their revenue growth is at such a clip that in the next 3 to 4 years, they might just double their revenues. And when that plays out, clearly operating leverage margin expansion also plays out. And so valuations are very reasonable at this time, in our judgment, in many of these names. So the opportunity set has expanded. A room to make money in this market situation is far greater than towards the last quarter of last year.
All right, a couple of more questions then. Let's talk about the EMS space because there is a tariff threat looming on Apple as well, right? But despite that, its plans to expand production in India seems to be on track. So, do you think after the correction that we have seen in EMS and the optimism around increased production, Apple production in India, is this a good time to get into some of these EMS names that have seen good correction of late? Keynes Tech, Dixon Tech, all these stocks have seen a good correction. Would you say valuation-wise, these are looking ripe now?
What has happened in this space is that over the last 4 or 5 years, they've seen significant growth in revenues and profitability, and as a result, valuations have gone through the roof. And when that happens, when your earnings growth is say 40%, but your multiple expansion is 100%, that 60% differential is the future getting priced into current prices. And the multiple expansion in many of these companies has been so significant that even after the recent correction, we don't see a margin of safety in these companies to go in and buy with gusto. We'd much rather be on the sidelines in general because we find opportunity in the rest of the market. Of course, this is an exciting space, so we won't lose track of this space. But we won't really put a ton of money to use in this space. There is that odd opportunity in this space, which while the rest of the sector was rallying, that opportunity or that stock wasn't doing so well, and its time is today. So we are looking at that odd opportunity in the space. But by and large, we find this space to be not offering a margin of safety at this time. So we are, I should say, to use a cliche, optimistic but cautious.
Optimistic but cautious. That's the stance on EMS as a theme. But what about China plus one as a theme? Abating tensions between US and China. Could that be a missed opportunity for India?
Um, One thing is for certain, Nandita, that in India, the capabilities that
Hmm.
China has, we don't have a similar sort of capability in India at this moment. But it's not like that capability cannot be developed in the country. In the example that you mentioned previously of iPhones, clearly India was able to rise above
Hmm.
its constraints and create opportunity in the country by taking that sort of capability and bringing it here. We see that in many other sectors that is a possibility. To give you examples, when you look at the API sector in pharma, now that sector, India used to have most of its requirement met in-house till the 90s. And fast forward to the 2000 and 2010s, and most of the API manufacturing moved to China. Now, clearly, we had the capability, but because of efficiency reasons, because of pricing reasons, China gained a foothold in this sector and beat us in the game. Can we get back that space back into the country? In our judgment, absolutely. Can CDMO, where India is a 3 to 4% market shareholder versus China being 50 to 60%, can that space come back to India in some measure? We think absolutely. So China plus one is clearly an opportunity, but we will need to calibrate and identify pockets and sectors where India will be a net beneficiary. Even textiles, for that matter, India can be a huge beneficiary of this trend. So clearly an opportunity, but it's not like every sector will move to India. We will have to play our bets in a much more calibrated manner.
Got your point, Anshul. But before I let you go, which are those themes that would feature high on your list, especially after the earning season, the fourth quarter earning season? Some pockets, the revenue growth is still missing. There could have been margin expansion on the back of some tax relief or some cooling off in raw material prices or something. But revenue growth per se has been missing for India Inc. Any pockets that stood out and where the future FY26, FY27 look more promising to you?
One is Nandita, where the current quarter has been slightly weak. But what is more important is what is the commentary of management of the future, and where is it that order books have filled up? So there are, I mean, let me give you an instance. For instance, Siemens. Siemens for the quarter witnessed a tepid growth on the revenue line, but both on the order book as also on management commentary. The body language that the management exhibited suggested that the future looks very bright, particularly not the very distant future, but the near future. And as a result, the stock kind of exhibited the strength that it did. And we see that in company after company in the capital goods space, manufacturing, capital goods, say value retail. If you looked at some of the banking sector stocks, their performance, even metals and the commentary that managements are giving on that space, to some extent, pharma, CDMO companies. We see that in all of these pockets, there has been tailwind in at least the expectation of the future, even if for one quarter or two there has been some tepidness in performance, but how they have filled up backlog on order book, how they are speaking about the future, that looks very bright. So clearly there have been green shoots in this quarter as well, and we anticipate that there is enough opportunity in the market for the future.
All right, there is enough opportunity for in the market for the future, and of course, the good part is that the bad news is already priced in, according to Anshul. With that, Anshul, would like to thank you as always for taking out time and joining in. Always a pleasure chatting with you, and I look forward to more conversations with you in future as well.
Absolutely my pleasure, Nandita. Look forward to that. Thank you very much.
Thank you. Thanks a lot. Well, on that note, as we come to the end of the show, we are down 200 points on the index, below that 24,800 mark as of now. It's a 700 point cut on the sensex. So the mid cap index, although is managing to outperform today as well, down 0.3%, but the Nifty Bank Index also in the red, down 400 points or thereabouts, and the list of gainers is extremely thin. Just about 2 gainers on the Nifty as we speak: Bharat Electronics and IndusInd Bank. Barring that, all 48 stocks on the index are trading in the red. In fact, the losses are being led by the likes of Grasim, Ultratech Cement, Eternal, NTPC, Axis Bank, and M&M. So yes, leave you there with the 200 point cut on the Nifty. Hopefully, it would get better as the day progresses. I'll see you on closing bell at 3:30 p.m. to take stock of how the market ends for the day, and with, of course, our stock list for the day as well. Till then, have a good one. I'll see you at 3:30 p.m. Thanks a lot for watching from the entire team. Have a good day.